Hey everybody, Brian Bogner here. Just want to take a few minutes and talk about the recent movement in the stock market. As you well know, we started the year not so good with stocks this year, so I want to take a few minutes and talk to you about that, okay? And here are the numbers. They don't look good. Large cap stocks, the S&P 500 down just slightly under 6% for the first week. Small caps even worse. When we look internationally, EFI or all of the developed countries in the world other than the U.S. down 6.5% just about. Emerging markets even worse, down 8%. Now keep in mind, China's a good part of that. China's been a lot of the issues here. Commodity index down 4%. REITs, real estate down 3%. And really the only thing that's flashing green so far the first week of 2016 is our bonds. But and so what we've done is this here looks at all of the first 5 trading days of the year, and this week here in 2016 is a historic down week going back to 1929. So it is somewhat significant. And if you look, this just looks back at history here, shows you what the worst 5 trading days look like, what the rest of January looked like, and the rest of the year. And basically, the average, slightly negative, and if we look at the median, a little bit more negative. Does that mean we're going to have a negative year in the market? It could. It may or may not. So again, we're just looking at some historical numbers to get some context, but it doesn't necessarily mean that's what's going to happen. And a lot of what I want to talk to you about here over the next few minutes is putting this in context, because I think that's really important. So what has happened? Well, yes, we've had the worst 5 days in a very long time. Keeping that in perspective, though, we are pulling down from all-time highs here in the stock market. And if we look at the S&P 500, now these are only large cap stocks, okay? But just to give you an example here, if we look at the S&P 500, and a lot of these charts today are going to be the S&P just because that's the data that goes back far. So when we think about some of the international indices or some of the small caps, things like that, we just don't have data going back that far. So a lot of what we look at the S&P 500. But we're only down 9% since the recent high in November, okay? And as you can see, even just going back 6 years, 7 years, 9% pullbacks in the teens have been very typical. I would even go and venture and say pullbacks 10 to 20%, even if you look back further historically, are very typical. So at this point, what we've seen is still very typical. We've not seen a lot of people that I've talked with already are thinking, hey, is this 2008 again? Are we about to fall off a precipice here? And at this point, we're going to say no, that the market is correcting. There are definitely some concerns out there. I do get the question, are we in a recession? Or, is there a recession about to happen? Our answer to that is no. And here's 2 reasons why. If we look at the initial jobless claims numbers, and this goes back to the late 60s, these gray bars are recessionary periods in the United States, okay? And every single one of them, you have seen a lift-off of initial jobless claims, either prior or right at that recessionary period. And guess what? That's not anywhere on the radar right now. So the job situation is okay. Second thing, and I won't get into all the technical parts of this, but we look at the yield curve. We take the difference between a 10-year treasury and a 3-month treasury and we plot it. Well, guess what? Going back to the late 60s, these recessionary periods, preceding a recession, in every instance, the yield curve is what we've called gone negative. And just for sake of this chart, means it's dipped below the 0 line. We are nowhere near that right now. The yield curve is actually pretty steep based on historic standards, and that's typically been very good for the economy. Which leads us to the next question, right? Can you have a decent economy and the stock market go down? Absolutely. But again, what are we talking about? Let's keep it in context and let's keep things in perspective. First thing is, we're going to look at a 5-year rate of return. We're also going to look at a 10 and a 20. Why are we doing this? Because we can sometimes get really caught up in the short term when it comes to stocks, and we don't want to do that. You don't buy a portfolio of stocks only to hold it for a year and then sell it, okay? And so the price of admission, though, to own stocks is that over short periods of times there will be losses. that is the price of admission. Over longer periods of time, it has been the best asset class to own for returns, simply because these are companies, they're growing, they're creating value, there's revenues, earnings, things like that. Over time, they still are the best asset class to outpace inflation and grow your assets. But they can be volatile at times, and you can also lose money. But that is the price of admission to own this asset class. So we just need to make that clear. And let's look at historically. Now this goes all the way back to the 30s. So we've got a lot of data here, okay, that we're looking at. So if we just take 5-year increments of the S&P 500 going back to the 30s, sure enough, I mean, right after the Great Depression, 5 years after the Great Depression, you lost 17% a year owning stocks. There was a period in 1942 you lost 9%. Over that 5-year period, 4%, 1%, 3%. Right? Most recently, in 2009, there was a 5-year period where you were down almost 7% a year. Okay, so this is 5-year returns, which I would say that if your time frame is only 5 years, stocks may or may not be the right asset class for you. Now let's bump that up to 10 years. What happens? Well, over 10 years, again, after the Great Depression, you lost 5% a year. In the 70s, there was a 10-year period, you were basically flat. Probably adjusted for inflation, you were negative, but without inflation, you were flat. And then sure enough, in 2009, you were down as well. Look where we're at right now over the last 10 years. Still a decent, this is 8.5%, but we're somewhere probably around 8% right now over the last 10 years. So that includes the 2008-2009 debacle. Again, there will be periods. Now, if we bump that up to 20, you can see here there's never been a 20-year period where since then where you have lost money if you held on it for 20 years. So I'm not trying to sugarcoat anything, but I just want to show you the reality that there will be periods that you do lose money when you own stocks, and that's just the price of admission. So what this gets into, and we'll just sum this up. First of all, let's remember it's only been 1 week. And as we looked at some of these declines here over the last 7 years, what's happening right now is very typical. We're still less than 10% from the most recent high. Again, very typical. We don't think a recession is on the horizon. We think it's unlikely based on some of the economic numbers that we're looking at. I've just said this price of admission on equities means losses over short periods, okay? Now, here really becomes to the crux of the issue. If there are losses over short periods, then what is the contingency plan to help limit those losses? That's what we're in the business to do. If you're not a client of ours, that's what your financial advisor is in the business to do as well. We do have contingency plans in place for 10, 20, 30, 40, 50%, depending on different levels of what we see the market doing. Okay, I can't tell you what that contingency plan is simply because it might be different for you or another client based on their asset allocation, risk tolerance, things like that we're managing through. If you don't know what that is and you're a client of ours, please call, pick up the phone, shoot me an email, and we'll go over in detail what that looks like. Okay, if you're not a client of ours, ask your advisor, what's the contingency plan if we have a significant down year or this happens? Just let me know what your thinking is and your steps to go through that. So we'll go and wrap it up there. If you have any questions, again, here's our contact information. Thanks so much for your time today, and we'll be in touch soon.